Can you all see my screen? And does it say adaptation modeling for the private sector and insurance? Yes. Okay. Then I have the right presentation in front of me. And so let me welcome you all to this parallel session where we will have presentations on case studies within basically two broad use cases as we have defined them, so the private sector and the insurance sector. And so we will have 4 excellent presentations that will dig in deeper into the subject of adaptation modeling. So briefly, the background of the project, and maybe before I continue, let me introduce myself. My name is Jeuken. I'm a climate adaptation expert at Deltares and part of the team that is organizing this workshop and with DG Klima and partners with the CMCC, the Institute, IVM of the VU University Amsterdam, and Paul Watkiss Associates. So the background of our study is to review adaptation modeling and how adaptation modeling can better support decision making. Also to come up with recommendations for the new EU adaptation strategy and improve informed decision making. So we trying to come up with recommendations for what we call 9 use cases, and we also present a number of case studies in the project. So there are two use cases related to the private sector and insurance. So we have one on business and finance, and I think the main criticism you can have this is really a very big use case, which is not very well confined because there's many different types of businesses, and also the financial sector is very diverse. But we had to make some choices, and then we have the insurance as a use case with some supporting case studies. And the insurance is of course a different sector because it's there to deal with disasters. And so what are the main challenges for these two use cases? Well, there's a strong drive from the TCFD and financial risk reporting environment to come up with better tools to also include climate resilience in the investment portfolios. But of course, there's also a challenge also to link climate risks to the real impacts that are being felt by the specific businesses or specific portfolios. And it's also very important to connect to existing industry standards or reporting requirements or safety requirements, etc. And of course, we also need to find a way to serve the sector with public data and models, but also allow for innovations and specific services to be developed by commercial parties. Well, I think with the presenters we have today, I think a lot of these challenges will be touched upon, and yeah, I think we will have a good discussion on this. Well, I asked the presenters to look at specific questions for this workshop today. First of all, describe what are the sort of decisions that need to be supported by adaptation models, and what is the capacity of the current tools to do this, and also to do this rapidly, and also to also give your view on how we can improve the situation and how we can come up to a recommended approach for rapid analysis. So what developments in data software that you see can improve things, or should user awareness be increased, capacity at the different users, what research is needed, etc. So we can give those recommendations back to the DG Klima to incorporate in actions under the new adaptation strategy. So this is the program for today, and some guidelines for the workshop. The workshop is being recorded. The presentations, please keep your time until 12 minutes maximum. Then we still have time for some questions. But also use the chat as much as possible to pose your questions also during the talks and start a discussion. So that's I think the best way of how we can do it. And please raise your hand if you want to speak out and take and pose a question to the presenters. So I think that's where I leave my introduction. So I would like to go to the first speaker, which is Wouter Botzen of the VU University in Amsterdam. I will ask if I'll unmute Wouter. Hi, Wouter.
Hey.
Hi. So I hear you. I suppose all the others hear you as well. So please share your screen and start your presentation, which will be on flood insurance models.
Yeah, so first of all, thank you very much for the opportunity to speak here today. So I was also part of the project team that did the desk review, and I will present some findings with regards to flood insurance models that came out of this review, highlight some state-of-the-art model developments, as well as some shortcomings that can be addressed by future research like Ad has suggested. So first of all, a short overview of what type of models are there. So there make a distinction here between models that are mainly used or directly applicable to insurance companies themselves, and actually show them on this slide. And later on, I will discuss also more other model approaches that are useful for regulators and people have a bit of a broader sectoral perspective on the insurance sector and adaptation that needs to happen there. So a lot of the models for insurance actually focus on assessing risk. So how is risk changing under climate change, which then can have implications for the way premiums are priced. So does this need to be changed? And changes in policy conditions. But it's also important for the in-house financial risk management. So for example, how much reinsurance should be purchased, what types of funds and reserves are required. So I think in general, a distinction can be made very broadly between two types of models. So either statistical models that basically analyze existing data, either on extreme weather events or on losses or claims themselves, which can be useful for deriving probability distributions of claims and loss events, on the basis of which premiums and, for example, required reserves can be estimated. But some of these models also take a bit more of a forward-looking perspective. So, for example, models in that domain have assessed, well, what are kind of the relations between weather variables and losses? So, for example, how do claims related to rainfall relate to certain rainfall indicators? And then people have used these empirical relations to also estimate, well, what if the weather changes? How then do losses change in the future? Which can provide an indication of well, what type of adaptation measures or policy premium conditions need to be changed under climate change. So overall, these statistical models work well if there's a lot of data available, which is the case for some extreme weather events. I just mentioned the example of extreme rainfall. Other examples are maybe hail damage. But many natural disaster risks are characterized as low probability events, like flooding, for example, or very severe hurricanes at a particular location. And then this empirical data is not available. And that's when people actually resort to catastrophe models that basically simulate hazard conditions and vulnerability and exposure, so assets located in an area, to actually estimate, well, what if a disaster happens, so a certain flood in an area, what can be the losses and what are the implications of this for the insurance industry. Now, many of these catastrophe models have been developed also by specialized companies, and they're readily available for insurance companies to estimate risk, and have also been used to assess, well, how can risk change under climate change. So overall, they are quite well suitable also for rapid analysis, I think, but very often they only assess changes in risk, but a broader translation is needed towards impacts for insurance sector itself, and I will say a little bit more about that later. Now, what are some other models that can be observed in this literature as well as field? Well, there are also models that have been used to assess climate change impacts more for the insurance sector as a whole, as well as, for example, what can be the influence of changing risk for consumer demand, etc. So these models can be distinguished in four categories. So first of all, there are catastrophe model applications that do not just assess risk changes for one particular insurance company, but maybe for the whole sector, which can then be useful because it can give an indication, well, how much will premiums in the whole sector, for example, change if climate change changes extreme weather conditions in a certain area. Such models have also been used to evaluate what type of insurance arrangements may be desirable to have in a country. So for example, in the Netherlands, there has been a lot of debate, like, do we want to have more private flood insurance systems, which we're currently lacking, or should we have a public-private system where, for example, the government acts as a reinsurer? And then these integrated catastrophe and insurance models have been applied to evaluate, well, what would be the premium if insurance is provided fully privately, and what would be the premium if there's also public reinsurance in order to give an indication whether it's desirable to introduce a public-private flood insurance or not. Also, actuarial models have been used, for example, to assess uncertainties in loss distributions, and also for assessing, well, what type of, well, allocations of risk between different stakeholders can be optimal. So if you think about establishing a public-private natural disaster insurance system in a certain country, then actuarial models have been applied to assess, well, how much of the loss distribution should then ideally be carried by consumers, what part can be covered by the private insurance sector, and what part is maybe not insurable, and for which maybe we need a public reinsurance. The last couple of years, we also see well, new innovative developments in terms of agent-based models. And agent-based models have mainly been used to simulate consumer behavior. So for example, if risk changes because of climate change in a certain area, how does this change the demand of natural disaster insurance among consumers? What if insurance companies start offering premium discounts for risk mitigation measures? How many policyholders would then adopt such measures? So especially to model these complex consumer decisions, agent-based models may be useful. And finally, partial equilibrium models. So these are models of demand and supply of the insurance sector, for example, in a particular market, which have been used to simulate, well, what if climate change increases natural disaster risk, like flood risk? How can this affect demand and supply in such a market? And I will give an example of such a model later on, because I think it's interesting because it really tries to take a comprehensive perspective, so a holistic perspective in terms of impacts of climate change for both insurance companies as well as consumers, and it can give indications about desirable reforms as well. Just another note is that we also did interviews with key stakeholders, which actually indicated that, well, there's an interest in like long-term forecasting of risk, but also to assess really what are the implications of the insurance sector for this. So catastrophe models, for example, are well, quite well suitable for assessing risk changes, but do not always make the translation on what does this mean in terms of socio-economic implications. So for example, related to the affordability of premiums, what will this mean in terms of insurance demand and protection gap, and also, well, how can we get insights for what type of adaptation measures by insurance, so for example, stimulating risk reduction by clients, are desirable. So more work is needed there. That's what these stakeholder interviews indicated. So what's an example of a modeling approach that tries to do this? So assess risk changes as well as implications for the sector and insurance demand. And well, an example of this is the dynamic integrated flood and insurance model. So this is a partial equilibrium model that consists of a flood risk model. So basically a catastrophe model that is run on glove risk data to estimate the risk of river flooding. And it can actually estimate this under many climate change and socioeconomic scenarios. It then also assesses, based on the type of insurance structure in place in the countries in the EU, what will be the premiums. And it takes into account, for example, whether premiums in a country are either risk-based or flat premiums, whether it's public or private reinsurance, and whether insurance is compulsory or voluntary in a certain market. So it actually translates risk changes to premium changes. Then there's also a consumer behavioral model that's part of this DV model that simulates in voluntary markets what will be the flood insurance demand in a certain area, but also depending on whether the insurance company stimulates risk reduction, for example, by offering premium discounts, how many of the policy holders are actually taking action to reduce risk. And what are then some model outputs that you can get? Well, this can give insights in, well, how do flood insurance premiums change, and are they still affordable in the future? What will be the market penetration? So basically the percentage of consumers buying the insurance. How much risk reduction is incentivized by different insurance arrangements? So for example, risk-based insurance or flat premium insurance. And it can also be used for evaluating desirable insurance market reforms. So I'll not have the time to go over all detailed model outputs, but I can give you a short indication of what the model results can look like. So for example, what does this show you here? Well, basically under a high climate change scenario, it can give you information for the future. How much more unaffordability could there be if climate change increases flood risk? And basically what this shows, for example, in red in Eastern Europe, you see quite some areas where kind of the unaffordable proportion of the insurance premium can increase substantially if climate change would increase flood risk in the future. On the other panel, you can actually also see what does this mean for the market penetration that's then expected in these countries in the future. And there you see that in such areas with high premium increases, the market penetration actually is quite low because the premiums are very expensive and unaffordable for many policyholders. So few people would buy that insurance. So of course, these predictions are not necessarily very hard predictions, they're simulations, but they can give you some insights about where can maybe problems arise with the insurability of future flood risk and what can be done about this. So the model can also be used for evaluating certain reforms of insurance markets. And I show an outcome of this in this picture here that shows that currently in Europe, you see a diversity of different flood insurance systems. So some are organized publicly, some are privately, either voluntary or with purchase arrangements. And what we actually simulate is that in the future, if you see risk changes, it may actually become desirable to introduce reforms that move more towards public-private partnerships, where also the government covers part of the flood risk in terms of reinsurance, because it keeps the premiums more affordable. And also it may be useful to introduce more stringent purchase requirements to make sure that the risk is spread over many policyholders, which also enhances affordability. So this is just an example of well, type of reforms that can be evaluated with a model like this.
2 minutes.
Yeah. Did you have a question, Ad?
No, I said 2 minutes, please.
Yeah. Yeah, so this is my conclusion slide. So just to conclude, what are some limitations and desirable improvements of models? So first of all, I think in general, it's desirable to have more models that can do a rapid assessment of what do changes in risk actually mean in terms of implications for the insurance sector. So implications for premiums, the availability of this, implications for demand, etc. Also, I think it's important in future projections to better represent vulnerability. So a lot of the catastrophe model approaches, they assess changes in climate risk based on changing hazard conditions, but they keep vulnerability constant. But in reality, of course, households and governments adapt to changing risk. So a lot of the risk forecasting by catastrophe models, in the end, they will not happen because people will take action to reduce the risk. And this needs to be better reflected in these future forward-looking risk models. Also, I showed you an example of an integrated model, right? That models both demand as well as supply side of insurance. So we try to calibrate that model as well as possible with consumer decisions based on actual flood insurance purchases, etc. But the data for this is very limited to do so. So more data will be needed to actually calibrate these type of models well. Also, I gave you an example of the Davies model that can simulate flood risk changes for flood insurance arrangements. In reality, a lot of the natural disaster insurance markets, they bundle different type of natural disaster risk. So for example, in some countries, flood risk is bundled with windstorm risk, etc. So I think we need more multi-hazard climate change impact models to actually assess the implications of climate change on insurance. And that concludes my presentation.
Okay, thank you, Wouter, for this excellent overview and presentation, and staying to the time as well. There were already a few questions in the chat. So there's a question: is it a global model, and do you also cover other hazards like hail, wildfire? And yeah.
Very good question. So we started with the Davies model as a European model. So it's funded by European projects. So we model the entire EU. And we're actually focusing on flood, mainly in the first model version, because also that data is well available for the whole EU. It was still a very big effort to make this model. But in the future, we want to extend it also to windstorm losses and perhaps local scale weather events like hail. So on a country level, there are good modeling approaches also to assess the other natural hazard risk than flood. But at the EU scale, yeah, the data availability was too limited to include that in this flood insurance sector model for the whole EU.
Okay. Then there's a question from Nico. Are there any scenarios addressing future vulnerabilities in the public space?
That's a good question. I'm not sure how to exactly interpret that question. But there are studies that, for example, take a forward-looking perspective in risk assessments and then account for what actions will the government undertake to reduce risk, for example, by building dikes, if flood risk changes, etc. So these type of models are available. If you really look at public sector risk, so for example, how much governments need to provide in terms of compensation for public infrastructure like roads, etc. There are some model developments there as well, but it's much less than in terms of household property damage, for example.
Okay, well, thank you, Wouter. I think we stop here for a moment for the questions. There are some more extensive questions in the chat that maybe you can continue answering them in the chat. For now, I would like to move on to our next speaker. That is Greg Davies from the European Bank for Reconstruction and Development. And he will speak about integrating physical climate risk into the supervision of financial markets. Greg, can you share your screen?
Yeah, coming up.
Okay, there you are.
Just a minute. Okay, let me just make sure this is correct. Okay, can you all see my screen?
Yes.
Great. Okay, then I'll get started. So thank you very much for the opportunity to speak today. I think I'm going to speak less about the mechanics of adaptation modeling and more about the context in which the outputs of adaptation modeling can be applied. Now, this session is about adaptation modeling and policy. Policy means lots of different things. It's not necessarily just, government policy, public policy. And I'm going to speak about a particular branch of policy, which is financial supervision, which is a kind of policy that has huge implications for the way that financial markets operate and for the private sector. influences the way that capital is allocated, influences the way that risks, financial risks are sized and priced, and how firms are valued. What's this got to do with adaptation modeling? Well, I'm going to explain that in the next couple of slides. I have some fairly high-level slides. I'm not necessarily going to speak to all of their details. They're more illustrations of some of the things that I'll be talking about. But to come back to that question I've just posed to myself, you know, what does adaptation have to do with financial supervision? And a bit of background on this. Well, I'm sure that many of you are fully abreast of this this topic, but we've seen in recent years that financial supervisors have realized that climate change is a source of systemic financial risk and a source of potential instability, financial instability. We've seen this going back to 2015, when Mark Carney, who was then the governor of the Bank of England, made a speech entitled "The Tragedy of the Horizons," when he first very eloquently set out the concept that climate change is a source of financial instability, a source of systemic risk to financial markets that financial supervisors need to take action on. Why is climate change seen as a systemic risk as opposed to other environmental or even social risks? Well, it's seen as being a global phenomenon. It's going to affect every country, every geography, and every part of the world. It's systemic in the sense that it will affect all sectors, all industries. And there's also an inevitability. It is going to happen. The world is going to change because of climate change, both in terms of the physical climate risks. So it is inevitable that we're going to see physical impacts of climate change. And there's also an inevitability to the policy responses. We are going to have to decarbonize. It is going to have to happen. There's an inevitability there that really makes this, from a financial supervisory point of view, an imperative, something that businesses, financial institutions, financial supervisors must take action on. Today, I'm going to focus mainly on the physical climate risk story because naturally that's what fits, that's what corresponds to the topic of adaptation modeling. Lots of acronyms on the screen. Sorry about this, but let me just very quickly talk you through some of them. I'm sure many of you know that many of you know well, but following the Mark Carney kind of intervention back in 2015, the Financial Stability Board of the G20 commissioned the Task Force on Climate-Related Financial Disclosures, which was a landmark moment in 2017, when this realization that climate change is a source of financial risk crystallized and materialized in the minds of policymakers and business leaders alike around the world. That has triggered a whole swathe of activities. One of them is the formation of the Network for Greening the Financial System, the NGFS, which is a coalition of, I think, now more than 60 central banks and financial supervisors who are kind of writing the rule book in some way, or at least setting out good practice for how financial supervisors should be integrating climate risk into their activities. This is then even now trickling down into even more mainstream things like the Basel institutions that govern, you know, banking worldwide and set the standards for banking worldwide. You know, we see now that the Basel Committee on Banking Supervision has established a task force on climate risk. So this is becoming very mainstream in many financial supervisors. And I've listed some of the individual central banks and financial supervisors at the bottom who are very active on this field. Obviously, you have some big European national financial supervisors, but it's also not limited to developed markets. In emerging markets, I mean, China is a great example where the People's Bank of China are very active on this topic. It's also happening in emerging markets too, which is a very important point. And given that this is a European Commission event, it's worth mentioning that the European Central Bank is very active, and they actually have their climate risk guide out for consultation at the moment. So in response to Ad's point, what are the future perspectives for European level action? Well, the work that the ECB is doing on climate risk is extremely important for the European context, and linking that through to work on climate science and adaptation modeling will be extremely important indeed. What exactly are these supervisors asking for? Well, they're asking for a lot. The recommendations are comprehensive. This is an example from the NGFS, their guidance on the integration of climate risk and climate and environmental risk into financial supervision. And you can see it's very broad ranging. I'm not going to read out every word on the screen, but you can see it covers many different levels of financial supervision, from the upstream governance of supervised entities. And I should say that when we talk about the supervised entities, it's both financial and non-financial firms. So financial firms like banks, insurers, asset managers, pension funds, etc., but also non-financial firms like corporates, for example, which could be in a range of different sectors, could be industry, could be extractive, could be services. If they're listed companies, then they fall under the remit of financial supervisors. So this cuts across a whole range of different sorts of financial and non-financial firms. As well as the governance, the expectations also cover things like strategy and how these entities integrate climate information into their forward-looking business strategy, risk management, how they integrate climate information into a way that they assess, size, price, manage risks, using scenarios in their stress testing to inform their forward-looking planning, and then disclosure, so that then they can communicate with markets, they can express to markets, their customers, their shareholders, their investors, their regulators on the action that they're taking to understand and manage those risks. I'm going to focus in the next few minutes on two of these levels, because arguably these two levels are the levels at which there's the most relevance to the integration of climate data. These are the sort of most data intensive, if you like, levels of this framework for financial supervision. So let me talk a little bit about the integration of climate risk into financial risk management. If you like, this is the kind of micro level. So inside a financial institution, inside a bank or an insurer or an asset manager, how are you really getting into the nuts and bolts of how you integrate climate information into the way that you manage financial risks? And what financial supervisors are generally saying is that climate risk, including physical climate risk, is not some sort of new type of risk. It's an amplifier, it's a driver of existing established forms of financial risk. So here you have, classic textbook definitions of different types of financial risk. What supervisors are saying is that climate risk, including physical climate risk, becomes a driver, an amplifier of these other types of financial risk. So you can see, for example, it's not difficult to understand that physical climate change impacts may affect credit risk through resulting in the loss of value, resulting in the loss of revenue streams, or the repricing of physical assets that may be damaged or vulnerable to risks such as flood, for example. Physical climate change impacts may affect markets. They may result in different demands or different availability of commodities on the market. Things like droughts causing spikes in agricultural commodities, for example. Operational risks to financial and non-financial firms. These can also be significant, with the operations of these entities being disrupted or affected by physical climate impacts. And then other risk types such as liquidity, where sudden shocks may also transmit into those sorts of risks. What the issue that we see is that there's an awful lot of work to be done in finding ways of translating the sort of messy, geolocated, very location-specific data that you get from adaptation modeling into the very sort of boring and linear systems that most financial institutions use for risk management. Now, these diagrams is just something that we've been working on internally. On the left-hand side, that's a mapping of all of the power and energy assets in EBRD's portfolio, and it's mapped against some sort of pretty basic mapping of levels of water stress. Now, if you're a climate scientist, this is child's play. This is very simplistic. There's nothing terribly complicated about this. If you're a credit risk manager, this is terrifying. This is really scary. How on earth do you integrate kind of spatial, messy, into a nice, neat credit model or a nice, neat spreadsheet that you use for managing credit risk across a portfolio? There's an awful lot of work to be done in this area, and I'm just going to very quickly run through three ways that we've seen that this can be done. One is a kind of high-level heat mapping type exercise, which many of the supervisors are asking for. We're also working on something like this internally inside EBRD at the moment. So we're looking across an entire portfolio, different geographies, different sectors, different industries, and we're just trying to work out where do we see the concentrations of physical climate risk across that portfolio. Where, the heat map, where do we see the hotspots of particular sectors, particular geographies, particular groupings of clients, of firms, where we think there's a concentration of physical climate risk where we need to dig deeper. So a kind of high-level portfolio view. Another option is to take a deeper dive into particular segments of your portfolio. So for example, I've seen some very interesting examples of some Dutch banks who have a concentration of mortgage lending in their portfolio, so residential mortgage lending. And there's been really interesting work in the Netherlands by a number of Dutch banks on taking a really deep dive into flood risk mapping and to look at their residential mortgage portfolios and to really map that in a more detailed and granular way by using, and the Netherlands is a world leader, you don't need me to tell you, on flood risk. So there's a lot of really great work in the Netherlands in terms of mapping flood risk work onto the mortgage portfolios of major banks. So sort of deeper dive into one particular segment. And then an even deeper dive can be when you take one particular firm and one particular client and really take a deep dive into that client's business model. And I've seen examples of, even trying to model things like cash flow, okay? So can you then rework the cash flow model of one of your clients, taking into account climate change projections? I think this might be going a little bit too far, personally. I think that there's a danger there that you end up with a false sense of certainty and a false sense of accuracy that may be misleading when trying to get down to that sort of micro level. And I think that's when we start seeing some of the communication difference between climate scientists and climate modelers and financial analysts and portfolio managers. There's sometimes, if we're over ambitious in how deep we can go, we may end up in some miscommunication. Very quickly, because I'm probably running out of time. The other level I want to talk about is scenario analysis. Now, again, many of you probably know this very well, but one of the big recommendations coming from financial supervisors is that firms should use scenarios, climate scenarios, to understand the uncertainties and also then to inform their future business planning. Now, this example I'm showing here is an example from some recent guidance from the Bank of England, Prudential Regulatory Authority in the UK. And they have set out 3 policy narratives, high-level policy narratives, for how they want firms to develop scenarios for stress testing their operations. There's no additional policy action, which means we don't do anything about climate change, okay? There's an early policy action, which is the optimistic scenario, that there's an earlier, that we respond quite soon to taking action on climate change and decarbonization in particular. And then there's the more pessimistic late policy action, which means that we don't do anything quick enough, but we do it a bit later on. And you can see that those kind of high-level narratives spell out different things in terms of, what might happen to carbon prices and what might happen to emissions. But when we get to physical climate, temperature changes, it looks a bit different because we don't see so much spread between the different dotted lines. And in a sense, this tells us something quite important, that when it comes to carbon scenarios, we have a great degree of policy sensitivity and policy uncertainty. So carbon pricing, emissions levels, they are influenced, and they will be influenced over reasonable timescales by policy decisions that we make soon on decarbonization. When it comes to physical climate, we know that there's huge uncertainty in our understanding of climate change. I've stuck this very, very familiar, AR5 IPCC diagram at the bottom. We know that there's great uncertainty over our understanding of how physical climate change impacts are going to evolve. And this is just temperature, which is maybe the least uncertain of them compared to things like precipitation and, wind patterns and extreme weather events. But the difference is really that when it comes to carbon transition risk, we're heavily influenced by policy uncertainties. We don't know how quickly society is going to commit to decarbonization. But physical climate risk is less sensitive to the policy choices because a lot of the climate change that we expect to see over the next few decades is baked in. It's due to emissions that happened over the past 100 years. So the influence of policy actions over physical climate scenarios is likely to be limited. What we need to be much more receptive to is to be sensitive to the modeling or the data uncertainties that are inherent in climate models. And my last point is to say, I think that's another area where there's a need for better communication between climate scientists, modelers, and the financial world, because I think a lot of financial models take climate model outputs on face value, and they take them as being the truth. And if you're on the scientist, and if you're on the modeling side, we know that that's not the case. So I think finding a way to communicate these uncertainties and the inherent uncertainties in climate modeling in a way that's understandable to the financial community is a real priority, I think, for future dialogue and communication on this topic. And I'll stop there, and I hope I didn't go over time, Ad.
Thank you, Greg. It was a great presentation, and you just passed 1 minute over time, so we will go with that. So thanks a lot. Just one question that I had is, you said it would be too overambitious to go to particular clients and then do a climate risk analysis for them. And my question would be, would not the responsibility for doing this be with the client, and that as a financial supervisor you would only ask for the report?
That's a good point, and I think that is, that touches on the question of frameworks for disclosure, because in many cases, it's clearly not reasonable to expect that financial institutions are going to do deep analysis of physical climate risk on every single client, every single item in their portfolio. What is more reasonable is that we're going to start seeing a cascading of disclosures, where financial supervisors are asking financial firms to disclose information about physical climate risk, and then in turn, the level below that, financial institutions are asking their real economy clients, the businesses and the households and the other entities in which they invest, to be disclosing information to them about how they have analysed and assessed and their physical climate risks. So I think it's a very logical point that yes, we would start seeing that cascading of information. I think though that what that also then means is that there needs to be a consistency. There needs to be some degree of kind of standardization in the sorts of metrics that are being passed along these different levels, because if we're all using different definitions and if we're all using different methodologies and metrics, then this transfer of information becomes meaningless. And I think this is the partly linked to the point I was trying to make, is that I think by overstepping the mark on the certainty that we can have about climate change impacts, and then passing that information up and feeding it up, you can see how you end up running the risk of having suboptimally useful information being passed up these levels. I think we need to have an explicit understanding of the inherent uncertainties, and so in order for these information flows to be meaningful, it's more about understanding and managing uncertainty than it is about pinning down the absolute truth about what's going to happen in the future, because that's not something that we can realistically manage.
Yeah, thank you. I agree, and also stay in the discussion, because for now we will move on to the next two speakers, and that will be talks from practice at serving companies, individual companies, and financial institutions. So the next speaker will be Nico Kroener from South Pole, talking about the application of climate risk tools for helping companies assessing their risks. So Nico, can you share your screen? Oh, you already did. Great. The floor is yours.
Thank you very much, and thank you for having the chance to speak today. I think Greg just did a really good job in making my my presentation even more easy, because he already set the scene for me and for the presentation that I give today, when it comes to exactly this question: how can companies answer the request, for example, from financial institutions on disclosing on TCFD and on their climate risks, and using the TCFD framework that Greg also already introduced with these 4 different components on governance, risk management, strategy, and metrics and targets. Maybe a quick just introduction of myself. Nico Kroener, I'm a senior manager here at South Pole, overseeing our offering to the market in terms of climate risks and opportunities, and how we can help in making exactly this communication between climate science and all the uncertainties to what you then finally can do and need in disclosure, and also for your internal processes in the company. Just a quick slide on who we are. So South Pole is active all around the world with a lot of different presence around the world, 90 different offices, different types of experts, and working on a lot of different solutions. One of these is exactly addressing climate risks for corporates. And I think what I want to highlight here is this specific point is that, of course, you need to be really have a deep knowledge on climate science and the uncertainties that are behind, but then it's as important to realize what is the data that you provide, the analysis that you provide, the results, in which context are they used, right? So are they used for certain disclosure purposes? Are they used for internal risk management processes? And then there's a lot of awareness and education that needs to happen in a company, right? So if you start to speak about different scenarios, about the climate model ensemble and internal versus scenario uncertainty and so forth, you look at blank faces on the other side. So it's really important that we work on this communication on these different uncertainties to make sure that the people on the other side understand the results and are able to also communicate these uncertainties further within the company, and in the end make really useful decisions. So this is our overall offering we address with this more strategic advisory, but then of course diving also in the details of physical risks and transition risks that I already mentioned, and today I focus a bit more on the transition risk analysis and the climate scenario analysis. Now, how does it generally happen? Just a quick overview is you have to always establish a baseline first, right? So it's really important if you speak about future changes, first you have to get a good overview of the baseline, because without having a good understanding of the baseline vulnerabilities and baseline exposure, you will be in total thin air if you go then out 30, 50 years into the future. And only if this baseline is established, then you can start to do the scenario analysis, where you then really go into the different scenarios provided by the IPCC, use different climate models, also use different type of policy models. And then finally, back from there, we then come to this financial impact, where already Greg said that's exactly one of the really challenging things, is even if you are within a specific client and you have all the information that the client in principle has, a company has available, it's still often very difficult to come to a good financial impact quantification, just because of this whole envelope of uncertainties that run from the climate hazards to the final financial impact. And an important point along this road is really these workshops, interviews, and data requests to really get the people using the data involved at all times, and also get the companies involved, so the different risk management, health and safety, financial risk management, everybody get involved in this assessment, because only then you are able to get all the information that you need to make a robust assessment. In general, how we deal with this kind of complexity is that you can always go into different details of such an analysis. Even for a corporate, you can sometimes start with just showing the hotspots, and then later going into more detail if the management is convinced to really do this type of exercise. I think it was important, and Ed mentioned in the beginning, to also speak a bit about what types of data models are used from us when we kind of translate climate science to a corporate. And this is, I just give here, just list a number of data sources. It's not an exhaustive list. I think there's a lot of more different type of data sources that can be used. And they, of course, are different for the different kind of parts of a climate risk assessment. That is, of course, an iterative process. So always you can go in more detail and then be informed by first go through these 3 steps and then start anew with the knowledge that you acquired along the way. But examples are using ERA interim, ERA 5 data, national risk inventories that can go in such assessment, public impact studies, so different work that is done from scientific institutions all around the world. It's of course very important within the baseline assessment, as I said before, that you really get company-specific impacts, historical impacts, as well as company-specific exposure. Where exactly are their facilities located, their offices, commuting to work, and so forth. And then if we go into the scenario analysis, there are different data sources, so like, for example, Copernicus or other data web portals like from the World Bank, where you can get different types of data. What do I mean with data? There is the general climate information, like the CMAP5 ensemble, Cordex information on downscaled, dynamically downscaled data. But then there's also, for example, the NASA Next GDP data set, which is like bias corrected and also statistically downscaled. So there are lots of different data sources available that you can access depending on how detailed your analysis needs to be and what is the final goal of the analysis. Of course, there are also kind of pre-processed data products available. For example, the Aqueduct tool that allows this type of really rapid analysis, which is a bit different, of course, if you start to look at CMAP5 data, where you have to do a lot of calculations first before you arrive at a meaningful assessment. And then finally, on the financial impact side, you have like company-specific financial data. Again, you need public impact studies to come to an assessment. And Ed, I think you ask a bit, what are the difficulties when we use that type of data? And there are different difficulties on it. One is, and it's maybe also Wouter already saw that from the question that I posted in the chat, is it's often unclear the copyright and commercial use of this type of data that is in the public space, which of course makes it more difficult for us when we want to translate it to a company, because we are offering a service, right? It's often more difficult to get really started with the work because it's unclear. Sometimes it's hidden behind only public use, or it's even hidden behind a paywall, but then it's unclear, like it's not a direct service, or it's kind of a complicated process to get to the data in the end, which makes it more difficult for us to provide the kind of the best data for a specific case. Then on the other side, predefined indicators are sometimes insufficient. So I, for example, listed also the ETCDI index, kind of this predefined indexes to define a heat wave, a heavy precipitation event, and so forth. But because they are predefined, it doesn't often match what a company is specifically looking for, right? So maybe the engineer is telling you after 28 degrees of temperature, the machinery starts to increase its fault rate. And you, of course, need to take that into account, but that you can't do that if you use a predefined indicator. And that is a problem then if you have no access to the raw data. Because if you would have access to the raw data, you could calculate these indicators yourself. Further, I think is there's no access to the raw data, you have problems with the statistical analysis, right? So there is different way of describing uncertainty, and the Greg already said it's really important part to communicate uncertainty. And sometimes in the public space, only like a median is provided, or maybe some type of robustness testing is done, but it's often not on the newest, not following the new standards that come from the science. So this is all something, if you don't have raw data access, you can't really do better analysis on that. And unreliable, that's of course a problem if sometimes with data that is public funded, the funding comes and goes, and then the data is not updated anymore, and then the access to this data gets unreliable. Overall, I think we have to find a balance between usability of the data, but also being flexible to do the own assessments. And I think works like this workshop really help in producing maybe data products that are more suitable for being applied directly. I think a general thing that we see, and also came out from the questions before, is geographical coverage and consistency of data, so that you can use the same type of analysis if you are in Europe or in India, and then if a global company is doing an assessment, they have like a consistent analysis. This kind of concludes my first part of the talk, and then I also wanted to give like a case study, right? So how does that then really look like if you really work with a company? And this is just one oil and gas company that we worked with that wanted to look at their risks, physical as well as transition risks, use that then for CDP as well as Dow Jones Sustainability Index disclosures, as well as aligning their sustainability report with TCFD, and including the risks in their internal risk management process. So we started off this overall project with initiation workshop, scoping. There was a big literature review done to kind of define where exactly we want to go, which scenarios we need to look at. And then we got into more in-depth analysis of different types of risks, and then provided together with the engineers, we worked on quantifying potential impacts financially. So what would it exactly mean if a if one of their production facilities would be off for 5 days or 6 days, what's the overall impact on their finances. And then finally, this was then presented in the final workshop, which was actually like 2 workshops to really have enough time to go into the details of the analysis and the results. And I can go into all of the different examples from these analysis. I just wanted to give you one example, which was on heat waves, where we looked at how certain heat waves are changing. The risk of heat wave is changing for different types of locations. And I think I would like to maybe focus a bit on the right side, where you can see we looked at different scenarios to cover the scenario uncertainty. We also looked at different types of significance levels. So how many models agree, for example, on the change of the climate change signal to provide an idea on the robustness. I think this goes in direction. I think that's really something that's still also from our side open, is how to communicate the uncertainty in the future, how to best make that visible for the other side, and how they should then feedback that in a CDP or Dow Jones Sustainability Index reporting and TCFD reporting. So that's really useful for a bank or financial institution to integrate that then in their own system. And to really communicate this uncertainty upwards, I still think there is a lot of work that still needs to be done on this side. Maybe even because the science is also not completely unique or has no clear way on how to best define uncertainty, because again, then it depends on which hazard you look at and so forth. But happy to have this discussion maybe later. And then just finally, then of course there needs to be an assessment of the financial impact. So for example, you go into really details and look at how the cooling system performance is reduced depending on the strength of the heat wave. And then based on that, you can quantify a certain impact in the future. And then finally, this has then to be integrated into a risk management framework, where, for example, this company, and I think it's something that's really common, is this separation between likelihood and impact. And then you needed to score the strength of the impact and the likelihood of this event happening, so that they could integrate it in their overall risk matrix, which in this case was this impact of heat waves on their cooling systems. And with that, I'm already at the end of my talk. I hope I stayed in time, Ed. And yeah, I mean, really looking forward to get your feedback, and would be super happy to collaborate with all of you in to ensure that we really use robust data and methodologies if we do this type of climate risk analysis.
Thank you, Nico, for your excellent presentation. I think this was very insightful. How you struggle and try to organize and especially also communicate climate risks and getting the people of the companies also involved and try to stay close to what they need. So you're sort of finding your way. That's good to see. Greg was also mentioning, well, we need some sort of standardization, maybe guidelines, and also the EU is working on guidelines with the taxonomy and following up standards and regulation, as you can see in the chat, as well as being mentioned. To what extent do you think that would help to have more standards, guidelines, and available, and yeah, how should this be organized, also with respect to the sectors and the industries?
Yeah, I think in the end it would be good to get more a bit stronger standardization on which indicators should be used, which type of analysis. I mean, I think there's already a starting point. For example, everybody is aware now that you should use an ensemble of climate models, right? If you start really at the end of the thing, I mean, it's no more or less clear. I think I still see if people don't use that, but I also think it needs to be a shift in the, I don't know how you see that, Greg, but I mean, I just listened to a lot of presentations also now on the new FI report on banking. And if you see these presentations, there's so seldomly an uncertainty bar presented in the analysis. Almost always it's just one number. And then if you ask, you say, yeah, in the details there we have some more uncertainty assessments, but I think it should be more, if you do this presentation, just be more bold about it. Yes, you know, there is uncertainty. I mean, maybe there's a pressure from the market to say, yeah, this is just this one number, but I think we in general should be more bold in pushing these uncertainties, make it more visible in public presentations as well. And then I think there needs to be more kind of, for example, in the Australian market, we see the CMSI work, so a huge group of people producing climate data, but also using it, going together and really developing what should you do for certain uncertainties, how should you disclose it, like it's maybe an annual loss ratio or whatever. So they really start to kind of drill down on the final metric that you should provide. I'm totally aware that will not always be possible. So I mean, can already see the people when I speak with the companies that they start to scream and you say, you know, you have to use this or that metric because maybe it's less useful for them. But nevertheless, I think having a standard and then you can still, you know, add additional analysis around that would really help. Also, yeah.
Thank you, Nico. There was a question or a remark from Jana Silman. Jana, can you speak out?
Yes, hello. Thank you very much, Nico, for this wonderful talk. I want to just have a comment or a question to you about the limitations you set in your little diagram. And you mentioned the ETCDI indices. We are also working in a project called Climate Invest, the financial sector and investors. And our experience is we wanted to help them to provide more tailored climate information. And so we approached them, and most of those people in the financial sector, banking and other stakeholders, they didn't know what they want. So the question in the whole project goes forth and back. We ask them, what do you need in terms of climate information? They say, we don't know, what can you offer? Then we come with the ETCDI indices because that's our best way of representing extreme events and uncertainties. And then we present that, and that doesn't resonate with them. So they cannot put it in their tools or risk assessment. So we are not smart. Anyway, I mean, for us climate scientists, it's the best way to present condensed climate information using these indices. But I have the feeling that often the counterpart in the financial sector, they don't know what they really need and want. So do you have the same experience, or how to overcome this barrier or gap of understanding in demand and supply?
Yeah, I think it's a great question, and this exactly same experience that we also often have, and we kind of make this open approach and we say, look, we can help you. If you tell us how you need the data, we can find the right source and prepare it to you. And then there's often silence on the other side, exactly as you described. What we realized when we work with individual counterparties, you can go through the cycle once, right? So you start with, for example, providing information on the ETCDI, then they realize, okay, that's not what I need. And then you go through the cycle again and say, okay, now based on your feedback, we can improve and adjust the indicators. And then over time, you kind of move towards something that is really more useful for them. The problem here is a bit, I see there's a certain resource that you need to put in such an iterative cycle, right? And there's not everybody is willing really to push that much time and resources into it if they don't immediately see the benefits. Yeah.
Okay, thank you. I think we have to move on to the next and last speaker, Gerhard Mulder, who will talk about his experiences working with financial institutions, and maybe he can also touch upon what Greg was mentioning on the Dutch bank, what the Dutch banks are doing. So Gerhard, the floor is yours.
Am I still on mute, or am
No, you're unmuted. You can.
All right, okay. Fantastic. So thank you so much. Great presentations, and I do believe that we are going to see, you know, I'm able to build on some of that. I have a few slides to share with you, and I will keep it a bit high level. Just a few words about who we are. Climate Risk Services. We were established late last year. We have an office here in Amsterdam and in Oxford. And basically what we do is we help organizations to become basically climate smart. And for that, we do use different sources of climate data but the philosophy that we use there is that we synthesize multiple lines of evidence, if you like, to build, you know, a robust storyline of plausible future outcomes. So let's see, what are we going to talk about today? Building on what the previous speaker already spoke about is, you know, what does the financial sector really need? Give you a case study of a large institutional investor, and then I have some ideas for the future, or frankly, I only have one idea, and I'll share that with you. So let's see, what does the financial sector really need? And you already heard a couple of terms being thrown around by Greg, you know, loss given default, probabilities of default, value at risk, etc. At the end of the day, they want something that quantifies their risk. That is what they really are looking for. So both on the physical risk and the transition risk, you know, you have different sort of transmission channels, if you like, and ultimately what that comes down to is either credit losses on loans, and that is of course, you know, most of interest for banks, and market losses on equities and commodities bonds, which is usually for larger institutional investors. So what you see is that investors, like institutional investors, they usually have an interest in knowing what the climate risk is on the portfolio level, whereas a bank may be more interested in, you know, ultimately, of course, also what their whole loan book, you know, the total risk of the loan book, but they really are much more in position to work one-on-one with their clients to identify that risk. One thing that I really like is Greg's overview of the different supervisory expectations. One publication that should not be missed by anyone is the ECB guide, which has defined a new set of supervisory expectations for banks in the Eurozone. And as part of that supervisory expectations, banks will be basically responsible for due diligence on climate risk of individual clients. And not only this, they will be held responsible for bringing those clients into alignment with the Paris Agreement. So that is a huge task ahead for these banks. Now, banks overall, I would say, are pretty, I wouldn't say lazy, but they, you know, the way they operate is they just say, you know, give me the data. They're not always in a position to ask the right questions. They just want to have, you know, what's my value at risk? What is the loss given default, etc. That is a bit of a danger, and I'll talk about that in a second. So let's go to an example of a large institutional investor. We worked with this company last year. It's a big one. They have about 500 billion euros worth of assets under management, so it really is one of the larger pension funds in Western Europe. They have a real estate portfolio of about 50 billion, so that's also a significant chunk of money. They didn't really know how many units exactly was in this portfolio because, you know, they have different investment managers. So they were interested in knowing what the physical climate risk was of that portfolio. So looking at different you know, flood risks, extreme weather events, drought, wildfire, heat, cold stress, etc. So we helped them with this exercise. And what we did was we used the concept of impact change. And this is based on the new ISO standard 40091. I really do recommend that you read or take notice of this particular standard, because it does provide some standardization in terms of how to approach climate risk. So if you're asking for standardization, this is a good place to start. So if you dumb it down a little bit, these impact changes, what you really are looking at is, start with climate change, right? That's okay. Global warming causes sea level rise, and that translates into hazards, right? So heat stress, storm surges, wildfires, and droughts. However, what you need to do, of course, is translate these hazards further into impacts. So, and that is, of course, again, dependent on the exposure and also the adaptive capacity of the particular asset. Now, unfortunately, the knowledge within financial institutions overall is not at the level that they really do know these subtle differences, perhaps. So they are presented with a score, which is really a hazard score, and they think that they now have a good grasp of the climate risk in their portfolio. And this is, of course, not the case. So then, what did we do? Our approach was to invite 6 different global service providers and ask them to analyze the same asset. And that asset is located here in the Netherlands. It is the designer outlet in Roermond, which is right on the river. And we basically said, give us, you have complete freedom. The only real requirement here is that you have to use global data sets. And what we mean with that is, you cannot use, let's say, regional or even national level data, because we have a global portfolio and we want to be able to compare the results across the portfolio. So 6 different providers, one asset. Perhaps it should not come as a surprise to you that the 6 different service providers provided 6 different answers, and it really was all over the place. So that is dangerous. There were a lot of variations in terms of, the types of scores. Some of these companies, they gave you a ranking 1 to 100. So your flood risk is, let's say, 67. Not sure what that means. Another one would say, high, medium, low. Another company gave a value at risk. Other companies, they included some level of adaptive capacity that was really, really sort of, very high over. For example, one indicator of the adaptive capacity was the number of ATMs per 100,000 inhabitants in the country. I'm not sure how that helped. So 6 different service providers, 6 different answers, wasn't helpful at all. In terms of data sources, were a variety of data sources, different data sources used by the service providers on flood risk, for example. Some of them used Aqueduct, others used Phantom. Another one is JBA, which is a commercial provider. List Flood was used. The Climate Impact Lab collaborates with, the Rutgers University. There's a guy called Bob Kopp, for example. So, it was a bit of a mixed picture, if you like. Some of the other indicators, there was a bit more commonality in terms of the data used. So we made an overview on the different risks. So where do the companies, score well? Where do they not score well? Well, some of them scored well on the climate data, but not all providers covered all risks. So that's a problem, even though they were working to add those risks in the future. But where they all scored, not high or, low, is on the impact. So yes, you can say, the quality of the climate data was often good, and they had a good grasp of the climate data. Translating that into hazards, most of them did pretty okay with that. Further translating that into impact, don't go there. So what they ultimately, sorry?
1 or 2 minutes to finalize.
So what the company ultimately did was selecting 2 of these providers and do a bit of a heat map analysis just to show where the hotspots in the portfolio was, and then take it, focus on those assets and do a more granular analysis. So overall conclusion then is, many of these service providers use publicly available data, but they put it in a black box and provide you with a hazard score only. The main problem there is that the financial sector lacks a basic understanding of these physical risks. They do not know which questions to ask. Now, one idea for the future that I have here, and that's a shout out to all of you, is really that we need to build partnerships. It is, if I look from my perspective, and I come from the financial sector, when I look at the climate modeling community, it's a really it's a strong tie network. Everybody knows each other, everybody talks to each other. That's fantastic. But what you really need to do is build cross-sectoral alliances. So we need to build networks where we include financial sector, the regulator, etc. One opportunity perhaps is that the NGOs, which was already mentioned, is now opened a work stream on closing the data gap. So that is something that is perhaps an opportunity that we start working with some of these regulators. And if you're interested, I can make those introductions, at least with people from the Dutch Central Bank. Another perhaps partnership, Greg mentioned the mortgage tools in the Netherlands. That is something that we're working on, as well as bringing the 4 largest banks and making them sure that they work together from the same data set, which is provided by the Climate Adaptation Services, and then define damage mechanisms and come up with data that they can use for the credit risk models. Thank you very much. That was my presentation.
Thank you, Gerhard. It was also a very nice and clear presentation showing also the danger of not mixing hazard scores with the real risk and impact scores. And I think such a benchmark as you did was a good way to address this problem. And also thank you for reaching out to build communities, and then also I think also you are calling out for more standardization as speakers before you. We are running a little bit over time. I would like to take 5 minutes to try to close this session. In the program it says that we would have a wrap-up. The formal wrap-up of these sessions, and all sessions, will be in the afternoon starting at 4 o'clock. So then we will have more time for a real wrap-up. For now, I would like to invite Greg, as he gave one of the overview presentations, also to respond to maybe the last 2 presentations to close off this session. And then I would like to invite you all to come back at 4 o'clock when there will be a wrap-up of this session, but also the other parallel sessions. So Greg, can I give you the word?
Thank you. I mean, huge thanks to all the presenters, but including Nico and Gerhard for adding a lot of the granular detail that I didn't present, but I'm really pleased that you did. I think between the 4 of us, we were able to cover a lot of ground, and that was without prior coordination. So that was great. A couple of things. I mean, I really agree with a lot of the things that Nico and Gerhard said. I recognize some of the same issues. I mean, this idea of different service providers giving you different answers, we see that all the time, and it's a big problem. In a sense, the question of standardization is important but tricky, because you could say that we have at the moment a bit of a sort of an unregulated marketplace of service providers, and this is a bit of a problem. Because we see often that different financial institutions seeking the service of different service providers, and they get very different products and very different information, and they reach potentially different conclusions, which is not helpful. At the same time, this is a newish field, and there's always that question of how soon do you regulate, how soon do you standardize, how long do you leave the marketplace to organically develop and let the market decide what's right and what's wrong. So it's a difficult balancing point that we see. I think also the question of the black box, we see this a lot as well, and it's something that we're quite wary about. We do often see the users of these service providers taking the product as a black box and not looking very deeply, if at all, as to what's inside the black box and what assumptions and what data and what range of models. I mean, Nico's point about about using an ensemble of models being a good practice point is really important. So I think on standardization, I think we need to move a bit carefully, because I think you could get this wrong. You could standardize in the wrong way too quickly before you know enough. But I think if I can stick a neck out a little bit, there's I think a need for a standardization of approach, a standardization of basic methodology, which is one level before you get into the sort of nitty-gritty specifics of, which models and which hazards and how do you define them. There's a level above that, which is just a basic approach. And I think, the NGFS guidance is quite useful in this respect, because it sort of sets out almost a two-stage approach, where first you have this heat mapping, okay, which is just where do you need to look deeper? And then once you've done that, the level below that is, okay, then when you've identified your hotspots, how do you dig more deeply into those hotspots? So it sounds quite simple, but even having some kind of basic good practice approach could be helpful, I think. When it comes to climate hazards, I think one of the things we see is that everybody's using a different taxonomy of physical climate hazards, and it's not helpful. In the work on the EU sustainable finance taxonomy, we tried to, within that group, come up with some initial attempt at having a bit more of a standardized categorization of physical climate hazards. But that hasn't progressed very far so far, but I think it's something that would be helpful. A few people in the chat box have asked about the EU taxonomy, and just maybe a quick response on that. I think the EU sustainable finance taxonomy has not been developed for risk management purposes. And this in itself is a point that's been discussed a lot over the past couple of years. But the Commission has taken, DG FISMA has taken the decision that the taxonomy is not primarily for risk management purposes. It is more for crowding in finance into sustainable finance areas, whether it's mitigation or adaptation or others. So, and there's been a big debate about, should the taxonomy be used for risk management purposes? There's apparently a current debate about whether there should be a brown taxonomy, which would be more used for risk management on the mitigation and carbon transition side. So it raises an interesting question about, could there be a kind of physical climate risk management taxonomy? Maybe, but I think we have to be clear that the EU taxonomy as it stands today is not really designed with risk management in mind. So it could be a mistake to assume that it gives clear guidance on that front. I have to stop now, I'm afraid, because I need to log off quite soon. So Ad, thank you very much again, and back to you.
Thank you, Greg, for your excellent response. And there will be more discussion possible this afternoon at 4 o'clock. So please, let's meet all there. And thanks for joining and your participation. Bye-bye.
Thank you. Thank you all.
Thank you.